Today's question is, what does add value to my business? This is something that I get asked a lot. This is something that a lot of entrepreneurs probably Google or people wonder about. So today I want to tell you what is the principle behind every answer that I give to entrepreneurs whenever I get to talk to them. So instead of wondering about that, you can actually draw your own conclusions. This is based on my experience. So I would, and it's a theory that I would say I developed over the years in talking to businesses and looking at valuations from time to time. So this is something I proved to be working for the largest majority of the businesses, if not 100%. But I also welcome feedback on this. So please feel free to comment on this video. So first of all, I want to change the perspective that some entrepreneurs have, that is one factor determines the value of a business, or one factor contributes to 90% of the value of a business, which in my opinion is not true. So the context of evaluating a company is always a sum of factors, right? And I give you a very quick example. If you just have an idea which is revolutionary, very cool, whatever, that alone is not enough to determine necessarily a valuation, right? Because that idea should be put in a context where that idea can be also executed upon, right? So again, and the execution part and the value that it can come out of that, that's also part of the sum of these factors that contribute to the value. So later on in this video, this is going to become a little bit more clear. Another thing that I hear quite a bit is like, yeah, but I have a patent, meaning that having a patent is per se a good reason to determine like a high valuation, which is not necessarily true. And again, later on in this video, we will see what this implies. The second aspect that I wanted to quickly discuss before we move on to discussing the principle that I came up with is that I start from the assumption that the valuation of every business is based on its ability to generate cash flows. Why? Because if we are evaluating business for profit, then we're talking about entities whose nature is intrinsically correlated to the ability to generate cash flows for the owners. Therefore, the value of a business should be based on how able the business is to generate cash flows in the future. So let me start by giving you 3 examples of questions that I may have heard in the past years. I have a patent. Does that add value to my proposition? I have a lot of experience. My team has a lot of experience in the field, so we should have a higher valuation. And C, we have a unique sales team, and therefore I think my valuation is higher. So are these 3 statements / questions true? The answer is it depends. And what I want to discuss today is exactly, it depends on what? It depends on, and this is the topic of today. For each of the previous points, I could actually raise some counter questions. The first is, okay, you have a patent. That's good for you, right? It doesn't mean you're going to make any money with that. You know how many patents are given every year, but they have no future? These are just inventions. So again, as I said before, having one factor doesn't mean that you have necessarily value, as long as that value is not, that patent is not put in a context where it can generate cash flows. We have a lot of experience in the field or in the industry. Also, like, what does that mean? Is it relevant experience? What tells me about the industry is gonna work in right now? What tells me about your experience in actually developing a business? Who can tell? And the third one is we have a unique sales team. Well, unique? What's unique about? What does it mean? Unique in what? Why is it unique? What is the capability of this team to generate cash flows? Right? So the principle on which I based my answers to these questions and on which my own theory is based upon is that a factor adds value as much as it's able to decrease the risk of a certain future cash flow, right? Which also implies that it adds value as long as it increases the chances that a certain company will be able to reach certain cash flows, right? So again, we're talking about a factor which is put in a context where it lowers the risk and therefore increases the chances of being able to reach certain goals, right? And I'm going to give you some examples about that. And please note that this principle, I like it a lot because it's based on objectivity, right? So if you have two companies, let's assume that these are two very similar companies, and they are in similar stage of development, they have similar markets, similar type of product and service, and similar growth potential, right? So we are assuming that these companies can reach an exit which is of similar magnitude, if not the same, in approximately the same amount of time, right? It's a lot of assumptions, but let's just take this as an example to understand the principle. So if we take these two companies, the company with the highest chance to, or the higher chance compared to the other of reaching that exit, should have a higher valuation today, because the risk is lower, right? So same company, same everything, but for some reason one of them has higher chance to actually get there, which means that if we bring that back, that future value of those cash flows, then today's cash flow for that expected value for that company is higher, because the risk is lower, chances are, and as other way around, chances are higher to get there. Let's take again this this context, this example, and let's say that company A has more experienced founders that probably already started the company, compared to company B that doesn't have experienced founders, but they're first-time founders with little to no experience in the type of business they are in, right? So again, these companies are pretty much the same in all the fields, but in this one factor. So which company do you think is going to have a higher value today, and which company therefore you think is going to have higher chances of success? Or actually, which company is going to have higher chances of success and therefore is going to have a higher value? Company A. It's pretty intuitive. So the answer to the question, does this increase my value, should be, does this factor put in the context of my company increase my chances of reaching my goals? If the answer is yes, then it does increase your value compared to a scenario where that factor is not present. Everything else unchanged. Let's take the previous three examples and let's see what is the mental process that would follow to analyze these factors. So the patent, right? Does the patent increase my chances of reaching some sort of cash flows and therefore my valuation? Well, it might, if having a patent is functional to lowering the competition, or better protect your product, your process, whatever it is, in a way that competition is lower, therefore margins can be higher, therefore and probably like sales is going to be bigger and better, right? And therefore the cash flows are going to be higher. So yes, it does increase your valuation in this context, but it may not increase your valuation if this patent doesn't have any useful implication on what I don't know, the margin or the competition, right? It's not that if all in a sudden you add a patent to a process that is not really functional to your business, your valuation goes up. Again, value, factors are always a function of the process of your company. Experience, well, experience, yeah, it can add value, right? As we said, as long as that experience is relevant to achieving certain goals faster, with less mistakes, right? Compared to somebody who doesn't have that kind of experience. So again, does it increase the value? Well, if put in the right context, it does increase the value. And the final part, the unique sales team, well, what should be unique about that is that its ability to close deal faster, or to close more deals compared to a team that doesn't have that unique feature in it. So does it increase the value? Yes, it does, right? In this context. So how can, this is the principle behind how to think about the sum of factors that contribute to your value. You should always remember that when you are negotiating or valuation with fundraising to sell your business, you're always going to have to present this kind of context to the investors or the buyer, and also explain why you think these factors contribute to the total value and in that amount, right? And one of the last remarks I have is that just to iterate on what I said at the beginning, that one factor does not necessarily contribute to the majority of the of the value at a certain point in time. Well, I've seen companies that just based on, I don't know, their patent or, I don't know, their experience or whatever, what have you, uh, are trying to achieve a valuation which is much higher of, for instance, their future financial performance, right? So what you see is that they have some kind of projections, right, that lead to let's keep it simple. They have some kind of projections about the cash flows that lead to a certain valuation, but they still claim a higher one because of their experience or what have you. Again, right? So if you want to claim that, then you should also explain how that factor is going to have an impact on the cash flows. But if the cash flows are already maxed out because beyond that level they would sound unrealistic for whatever reason, like the market is not big enough, then I'm sorry, your experience doesn't add any value to your business, because that's the maximum valuation you can get. And still, that experience is functional to that value, but it cannot go beyond that valuation, right? That's something I see a lot, so just wanted to bring that up. So bottom line, how to make decisions about the factors in your business process and which ones actually generate value. Well, always think if whatever you're investing into or whatever you are focusing your attention on increases your value by, first of all, increasing your chances of generating cash flows, or to increase your cash flows for any reason, or also on the other side of the same thing, lower the risk, the intrinsic risk of your company. If the answer is yes to these questions, then that is an investment that adds value to your company. If it's not, you draw your own conclusions. So I hope this gives you like a framework in which you can think about even your management decisions, because in the end of the day, managing your company should be about building value and not necessarily focusing on therefore short-term goals, but rather focusing on what maximizes the performance of my company in the mid to the long term, right? So I hope this helps you, and I'll see you in the next video.